Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, March 11th, 2020. Wanted to cover just a few things, some of the things I haven't talked on recently, just kind of a random mix of different charts. I want to talk a little bit about Palladium. I've been highlighting, watching for that for a long time, major top in that coming, and I think we're, like I said, we needed the stock market to break for that to break, so that's happened. But let's start here. Now, everything that I'm covering in this video, most of what I cover, especially lately with my hyper focus on the stock market, not as many individual stock trade ideas, only because right now the markets are moving. There's plenty of opportunity to be made, and I'm looking at the big things, and all of this stuff comes together. My background originally was in fundamental analysis. I'm, business major, college, started out after graduating, went to work at Merrill Lynch as an investment advisor, stockbroker, whatever you want to call it. And that training was mostly, all fundamental analysis. That's, how does the economy work? Microeconomics, macroeconomics, fundamentals of companies, and all that. And over the years, I kind of fell in love with and discovered and was really self-taught technical analysis. Instead of trying to, analyze a company's balance sheet or, what is their next, their potential for, Apple to sell iPhones, what's that going to do to their stock price? Take a look at the chart. And to me, of the two, the charts are a much more accurate guide as to where a company is going. Particularly in the near term, and then and even more so for identifying the exact levels, where to buy, where to sell. And I will say this: I do use both fundamental analysis. The best trades, my best long-term trades and investments, come when the fundamentals and the technicals align. In other words, when you can make a bullish case for a company fundamentally from a fundamental perspective, and then you can also make a bullish case on the charts. So we're going to talk fundamentals for a second. This is something I've covered over the years and I've talked on, and it is one of, I think, the biggest one of the biggest problems facing this country, the United States, as well as financial system. And I'm not the only one's talked about this. Is the severe underfunded shortage in pension plans. The majority of pension plans are underfunded. I think it's by nearly double their current assets to what their liabilities are. What I'm talking about is pension plans. CalPERS is the biggest one, so I usually pick on them because I believe that's still the world's or the nation's largest pension fund, and we'll start there. So what I found is an article. I just want to say this is recent stuff. So February 10th, 2020. Let's put this in reader mode so you can see a little bit better. I'll just highlight a couple key points here. Let's make the font a little bigger since we're on YouTube, and then I'll highlight what I'm trying to show you here. Get back up to the top. So again, it's a recent article. Over time, CalPERS will publish their asset allocation mix from time to time, but you can get things like this. Quick Google search. So what am I concerned about right now? It's first of all, it is a huge pension plan, $384 billion. And what just scares the hell out of me, personally, I think they're the people running CalPERS are on borderline criminally neglect what they've done in recent years. 10, almost 11 years into the longest bull market in history. We know, it was statistically a certainty we're going to see another recession and a bear market. As each bull market exceeds its average. Historically, the average bull market run was, I think it's like 5.5 years. You're going to see different numbers, and so this one's more than double that. All we know is we're in the probably if it's you want to compare it to a baseball game, like I said, you're probably in the 13th, 14th inning. I can't remember. I looked it up one time. I think the longest baseball game in history was 18 innings or something. I don't know if you guys are familiar. In baseball, there's no tie. You keep playing till someone scores. It keeps going to an extra inning. And anyways, that's what's happened there and going on with the stock market. So to see a pension fund with so many people's livelihood, this is where all the retirees that are dependent on CalPERS, they're dependent on them to have that money there for them when they need it. And as you guys know, what's going to happen? Shortfall is going to have to cut benefits. They're going to have to do all types of things. And let's just go over the numbers here. So here it is. They had 80% of their portfolio invested in stocks and bonds as of September 30th. 80% of their money. So now let's look at what's happened. The stock market has dropped 19% in just a few weeks, from the highs to the lows. And look, I've said this a long time. It's been priced in the charts. It was priced in the charts a year ago. It's just taken a long time to play out. And those things can happen. Divergences build, overbought conditions, extreme, excessive valuations, extreme bullish sentiment. And I always say those things can continue until they finally pop. Now, what's a little bit different this time around, other than the fundamental, the macro, the background I'm talking about, what I think coronavirus, the impact it's going to have on the economy. This is certainly different from that big drop in 2018, where it was just kind of a mindset, the economy may be turning, there was a little panic, and but this time around it's real. I mean, these are things that you're hearing across the board, meetings being canceled, airlines flying half empty, people staying at home. So I don't think one can argue if it's going to have an impact on the economy. The big argument is only going to be how much of an impact. And so we've already seen the market drop 19% in short order. Where am I going with this? Well, okay, when the market kind of has a slow roll, and when the macro fundamentals, and the economy start to head down, what I'm talking about is, week by week, there you can check the economic calendar. I have a link to the economic calendar on the site. It's under the, on the top menu of the site. Click resources. You go down to tools of the trade, and there's a link to the economic calendar. So they publish all types of government reports, employment figures, consumer sentiment, gross domestic product, all that kind of good stuff. And where I'm going with that is, when the economy turns, and usually the economy is like think of it like a super tanker out at sea. It's not going to turn on a dime like a little, ski boat can. Super tankers take a long time to make a turn, and that's usually how the economy works. So where I'm going with this is, with these, the gurus that are running pension funds like this and hedge funds, they can usually see a turn coming if they're doing their job right, and they can gradually then reduce their stock and bond portfolio allocation, or shift. They might go more into bonds and less into stocks. That's usually what you do historically. Now, times are all different. The Fed, like I showed you yesterday in that historical chart for the 62-year rate of federal fund rate, we don't have anywhere else to go now. But as far as interest rates, we've pretty much at the floor. And again, don't hold me literally to that. Yeah, you can go down another quarter point, but you're pushing on a string. Rates are near zero. So in the old days, if the stock market correct, bonds went up, and vice versa, and that's why you had a mix. So, but what I'm saying here is this is a very heavy, I think. An over allocation to stocks and bonds. We'll get down here in a minute. And then what happened with coronavirus, again, everything was priced in the charts for a while, that we'd have a correction and possibly a bear market. But what coronavirus did is it made things happen very quickly, because it was a catalyst, and it kind of snowballed by the time you started hearing about it. It was a little thing, and the market fell very fast. And more importantly, I think what is the change in the fundamental outlook for the economy, with all of these business meetings being canceled, sporting events, concerts now I'm hearing being postponed. The world's largest music concert or gathering, whatever it was, I can't remember the name of it, I saw the headline, that's been postponed. All of these things have direct financial repercussions. People staying at home, not going to restaurants as much, not flying in airplanes, hotels. So, okay, I think you all understand that. I'll beat a dead horse here. But what happened is, instead of usually the usual slow roll where you can kind of, the smarter economists and the smarter fund managers can kind of pick up on a trend of a slowing economy, this one was a quick drop. And so, you can't move on a dime here when you're running, $400 billion. You start to trim out your equity allocations. Do the math. Let's see how much was that. Let's go down here a little bit. Where was it? The stock portion. I think I had that down here. Let me pause this and find it. No, there it is. Here it is. So CalPERS most recent strategic asset allocation increased its equity allocation to 50% from 46%. So half of that $384 billion is in stocks. So do the math. What happens when CalPERS wants to pare that back to 35, 40%, whatever it is, even 45, back down to 45, they were at 46 before, to reduce their equity exposure? That's going to cause a lot of selling pressure on the market. And of course, CalPERS is only one. Again, picking on that because it's the biggest one. You have tons of other pension funds out there and things like this, and they have fiduciary responsibility to the pensionees, or the future those currently drawing a pension and those that are will be. So they can't sit there and do the old hope and pray like a lot of individual investors do. I'm talking about 2007 to 2009. I'm talking about that's the last bear market. I'm talking about 2000 to 2002, the last previous bear market before that. A lot of individual investors do what they call hope and pray. They just hang on tight, panic, and hope that then the worst is going to be over, and over time the market does bail you out. So but it can take sometimes years or even decades to get back to where you were. These guys can't do that. They can't ride a $384 billion fund down to 100 and whatever that would be, cut in half, 170 billion, because the last bear market, last couple bear markets were over 50% drops. They can't ride that down, so they have to then take protective measures, and that's big concern to me. And again, multiply this by a lot of the other pension funds out there that are doing the same thing because they've been grossly underfunded for many years. They're taking excessive risks, and this is also an issue that the Fed forced them into. The Fed, by bringing rates down to near zero and keeping them there for too long, they had no choice but to chase returns and riskier assets like stocks. And you can see they also boosted their fixed income up to 28% from 20%. So now where am I going with all this? Well, okay, yeah, the stock market, that quick swoon down, has caught a lot of institutions like this off guard. And normally, and again, this is going back for 100 years or more, when stocks go up, bonds typically go down, and then when the stock market corrects, usually bonds go up. And that's the old, like I talked about it, the old school rule of thumb, on a asset allocation model, is the number 100 minus your age should give you how much you should be in equity. So someone 50 years old ideally would have half their money in stocks, 50%, and half in the bonds, whereas a 30-year-old might have 70% into bonds, 30% into stocks. And the reason is 30% into bonds, 70% into, no, yes, correct, 30% into bonds, 70% into stocks, because that 30-year-old has a much longer time horizon, whereas then you get the older person who's, let's say, 70, they're in retirement, and so at most maybe 30% stocks for them, 70% bonds, and that would be because they can't afford a 50% drop in the stock market. They don't have the time to recover from that, to have their portfolio recover. Plus, bonds also spin off income, at least in the old days they used to. They're not spinning off a lot now. All right. So what happens here is the other benefit of asset allocation, again, is that typically when the stock market corrects or has bear markets, bonds used to go up. And again, that's going to be severely limited this time for the reasons I showed you with the 10-year bond, the treasury bond. At last I checked, it was 0.4%. We're near zero. So falling interest rates, where they normally cause the price of bonds to go up, there's not much room for rates to fall here. So there's very little upside potential, capital appreciation potential in bonds. And now even worse, because of what all the the unique circumstances that we've seen in recent years, talked about, and the reason for the LQD trade, and the reason I'm starting out here on this part of the video, because this stuff is all interrelated. This is everything that I had talked about coming to fruition right now. This is what, and that's why I wanted to jump in that trade. Usually you don't see me enter a short trade when something is on support, because TA 101 says you do one of two things when a security falls to support. You either step in and go long there, buy at support, expecting another bounce off the trend line, or you wait till a breakdown. But I said I wanted to get in front of it, and that's why. Look what happened yesterday. Had we not shorted here on Monday, had I waited too long, I wouldn't have entered this trade. I would have said, well, shoot, missed that one. It's already down to support. And now here, it's already smashed right through that first support zone. So right or wrong, this helps me to confirm that my theory was correct, that we are seeing, because of this rapid shift in the fundamental outlook of the economy due to coronavirus, coupled with the technicals on the charts, we're seeing before it's even happening, and I'm sure they're in the works now, Moody's, Standard & Poor's, AM Best, those bond rating companies will be downgrading a substantial amount of that lower tier of investment grade bonds sitting at the triple B rating. Anything below triple B, you go down to double B or below, that's junk status, and they get sold. They have to be moved out of here. And the big risk is everything is sudden and you get a rush for the exits. That's why you're seeing the biggest drop of corporate bonds in years, and we may see the biggest drop in history, I think, before all is said and done, because of those, again, unique and extreme situations with the massive amount of the corporate bond issuance in recent years being issued at that lowest tier of investment grade. So there it is. And then back to CalPERS, what does that mean? Well, CalPERS decided just recently to up their stock allocation. All right, we already know what happened in the stock market, what can continue to happen, especially if the impact of coronavirus continues. More and more people kind of pull in their shell, more companies pull back, and it has a ripple effect in the economy. Even if it doesn't, I think already the effect from just what we've seen now will be felt for at least a couple quarters here, not just a month, not just 2 months, at least the next couple quarters. And then, of course, at the same time, they upped their fixed income to 28 to 20%. Now, a lot of what they're chasing, I know this, looked at, a little deeper into it. You're not all into treasury bonds. Yes, treasury bonds have been doing very well because that is the king of flight to safety instruments. But treasury bonds don't pay squat. So I can assure you that a good portion of CalPERS, fixed income portfolio was in investment grade bonds and lower, junk bonds, below investment grade JNK, which has just been pummeled lately because of course, the same reasons, economic outlook, and with oil crashing. And keep in mind, a lot of the high yield market in junk bonds, high yield bonds, is in the energy sector, and we all know what's happened to the energy sector with oil crashing recently. There's no, that's not USO. There's USO, crude oil falling off a cliff, on a huge plunge of 50% in a matter of 2 months. And of course, the energy sector going right on down with it. Here's XLE, clearly in a bear market. So just kind of looping back to where I was, I just wanted to tie in that it's a double whammy for traditional asset allocation investment. I'm not trying to pick on CalPERS. I'm using them as an example. A lot of this, even though again, if it was my fund, if I was in there, I would say, look, you guys, this is, yes, we're underfunded, but by chasing return, by going into risky assets at the, 11 years into the longest economic expansion in history, all recessions start, by the way, when unemployment is at record lows, as it has been, when everything's chugging along, and when the Fed creates an environment where they've supported the market for too long, too aggressively. Every little pullback, they let that 2018 correction, they came in, as I suspected they would, and flipped instantly from a hawkish to a dovish stance. They were hiking rates before there and talking about continuing to hike, and as I predicted, market would drop and then they would flip to dovish, and they did, and that's what caused that explosive rally off the December 2018 lows. But again, I'm kind of a purist when it comes to economy, and a little bit of kind of that hands-off approach where let everything run its course. You need recessions, you need corrections in the market, and so the Fed has just kind of created a bigger bubble and boxed and force these pension funds into taking this kind of risk. And so the impact is going to be devastating when these losses are realized. Maybe the Fed will come somehow, central banks will come again to the rescue and save the day, but as they continue to use up all their ammunition and bullets. What's going to happen when CalPERS realizes the losses that they've had now? And what happens? Just let this go. Even if you think I'm overly bearish, just say, let's just say we have another 50% bear market. Another, equities are going down 50% from where they were. That's just the average last couple bear markets. We've only dropped 19%. So we go down another, let's say 30% over the next year or so, next year or two, and again, the upside on fixed income is limited, and even worse, if I'm correct, and we have this cascading effect of a rush for exits as all these investment grade corporate bonds, or a good part of them, I should say, not all of them, are downgraded into junk bonds, and therefore they must be sold. Again, that's not an option. LQD does not have the option to continue to hold those bonds. They have a huge issuance of triple B bonds that they must sell because they will be junk rated, and that is not the directive, or what's in the prospectus for this ETF. It's to hold investment grade corporate bonds. And again, this is just one of many. Like I said, there's, look in your 401k. I can almost assure you, if you're not in it now, one of your options, or bulk of your bond options, are going to be, funds that do the same thing. They're holding a lot of investment grade bonds, and by prospectus, probably each and every one of those funds most likely will have a limit as to how much, if any, of below investment grade or junk bonds they can hold. So therefore, those fund managers, like it or not, even if they think, well, it's a temporary thing, it's going to snap back, by mandate they must sell out. And when everyone's selling at the same time, bad things happen. So there it is. Look, I hope I'm wrong. I don't wish doom and gloom upon the economy or the stock market, but I just want to point out, as I have a ticking, potentially ticking time bomb, and with this impulsive move down, slicing right through support, it seems to be there's a good chance we're heading that way. So I extended that target today on this trade, and as I already showed you before, where I think there's a good shot we can come down, and there might be a lot more downside. Things move fast, so don't be surprised if I decide to do the same thing with QQQ, where I just kind of say whether I add a third target or fourth target. I might just say, look, I'm going to leave this as an open trade. We're going to lower the stops, maybe some point soon, tomorrow, whenever. I can say this now. It's not a bad idea if you shorted this one right here to lower the stop to at least break even. LQD could certainly snap back if something happens in the market, but that would be, I think, at this point, my best case scenario, and I do not see it happening. But a snapback rally, maybe back test the trend line from below and then move on down. So up to you whether you want to stick with, I think the stop is somewhere up here. Was it 134.50, 133.50, I think, if I remember right. It's not on this chart for some reason. So that's that. Just want to share with what's going on, and it's just not going to be a good thing as these pension funds are taking these huge losses, and at some point paper losses turn into realized losses because they have to again plug the leaks. They cannot do that hope and pray. They're going to have to mitigate, cut their losses, and by doing that, what does that mean? Well, they've got to sell too. They've got to liquidate those invest some of their bond holdings. They might have to liquidate some of their stock holdings, and when everybody sells at the same time, it's simple. It really is. That's why you look back in time. If you're new to this, just go back in time and look at the stock market at any period, and you will see the same thing I talk about all the time, and why I actually love shorting stocks. I love going long too, but I love shorting stocks because what happens in a bear market, stocks tend to fall faster than they rise. You wipe out usually years of gains in just months. Here's the last bear market right there, and you can see that it wiped out in just about 18 months. It wiped out gains going all the way back to the mid 90s right there, in just 18 months. Gains that took, again, wiped out the entire preceding bull market and then some, and that preceding bull market took many years to go. There's the scaling down here, and so you just have to look at possibilities and potential. And let's just say we have a run-of-the-mill bear market. Let's retrace 50% of this bull. But let me find a clean board here. This is good enough. Let me put up Fibonacci retracements and go here. And let's just say that we retrace. We'll do it backwards like this. Delete. Let's go here. Remove that Fibonacci line and add it down here. Go this way from top to bottom. Is that what I did before? Let me see. I'm sorry. Some on fib lines, they go backwards. You draw up from the top. Yeah, that would be okay. That's it. There's it. A 50% retracement of this bull market. Bull market started back here in March of '09. Would bring the S&P 500 or SPY down here to about the $200 level. Now I have my bear market. It's been here for over a year now. I told you I'm targeting the highs right there of 2015. Now it's a flexible target, but so either way they're close enough, and that would take us from the highs to the low. I can't grab right there. I moved. Yeah, I can grab. There it is. That would take us to my target from the highs was about a 37% drop, and a 50% retracement of the previous bull market would be about a 40% drop. And that's just a that's a run-of-the-mill bear market. You could certainly come down here and test these peaks right here from 2008 and 2000, and that would be a much larger drop. So who knows? Well, I said this morning, technically we're not in the longest term trend. Majority of the long-term trend indicators are still bullish. This month maybe that changes. What am I talking about? This is one of many right here, this 20-month exponential moving average. But we're below it now on SPY, but it really, all that matters is it's a monthly chart, so we have to see how this monthly candle closes. If we can get a rally towards the end of the month and close above it, it keeps that bull bear market trend indicator intact. And I'm covering this now because I know there's always new people coming to the site. There's a 20-month, just does a phenomenal job of defining bull and bear markets. When you're above it, you're in a bull market. When you cross below it, again, a solid monthly candlestick close below, you're in a bear market. It's not perfect. There's a few whipsaws here and there, but I challenge you to find a more effective indicator that's as simple as just one single moving average. Again, it's 20-month moving average, if I didn't say that. And there it is, bear market from here to here. Regained it there, you're in a bull market. And again, you'll see occasional whipsaws, but for the most part, does a really good job. And so SPY is starting to crack, but we still have several weeks left in the month. QQQ is still comfortably above it for now, and I can also turn on the bull market trend line. So somebody asked today what I meant about the long-term trend being bullish. By these two metrics here on QQQ, which has been by far the leading index. The NASDAQ 100 has been stronger. It has led the bull market up. It is top heavy in the stocks that have carried even the S&P up, and that's Amazon, Apple, Facebook, Microsoft, those big names. You have a bull market trend line that comes off the lows, and when the NASDAQ actually bottomed a little before the rest of the market back in late November of 2008, the rest of the market's indexes bottomed in 2009, early March, and you also had a reaction there. So this is your bull market uptrend line. It's nice and clean on QQQ. And then that 20-month EMA, again, just has done a phenomenal job, turn all the lines off, of showing you, and if going back as long as you want, showing you the trend, bullish trend when and pullbacks to that line act as support during a bull market. You broke it back here in 2000. You entered a bear market. It was a vicious bear market. Doesn't look like much when you're looking over such a long period of time, but it was. And then boom, bull market there. Did a great job of defining the bull market. And then there's your 2008 to 2009 bear market. Again, doesn't look like much when you're going back so far in time, but you can see it here. And remember, that was a over 50% drop from the highs to lows. So that's it. So there's your trend indicators. There's where we're at. Maybe this all blows over. Maybe coronavirus is not as bad as everyone says. Maybe people get used to it, immune to or not immune to the virus, but immune to the noise from the media, and who knows? I don't know. All I know is right now I can tell you that it's everything that's gone on lately will certainly have an impact. Not almost, will certainly have an impact on the economy, at least for the near term, and possibly quarters out. And the thing about technical analysis and the way all this stuff works, it's kind of interrelated. So let's say it knocks down at right now they're forecasting, oh, okay, it's going to set the US back a couple quarters, maybe trigger two negative quarters of GDP, which is technically a recession when you have two contracting quarters, two consecutive contracting quarters of GDP. That is the definition of a recession. But then what happens is there's a domino effect there as well, because the stock market and consumer sentiment go hand in hand. So when the stock market drops 20-30%, consumer sentiment goes down. The consumer tucks in the shell because they've seen their 401k and their savings plan that they had set aside for their vacation fund, whatever it is, that goes down. And then there's a domino effect. The same reason in the Fed, Bernanke, who was Fed chairman at the time, he stated it. He didn't, try to hide it. One reason they were gunning rates down to near zero and flooding the market with liquidity was to buoy consumer confidence to get the stock market up. He acknowledged when the stock market goes up, consumer confidence goes up, and then it's a vicious cycle, and the economy should do well. And so it works in reverse now. So these are all the things that I kind of wanted to point out. And like I said, the scary part where I loop back, I'm talking quite a bit about this. It all comes back to the that what I believe to be a dangerously aggressive asset allocation mix by not just CalPERS but a lot of these pension funds out there. And so, like I said, all this stuff is interrelated, and so these are things to watch for. You want to see, ideally, to see stabilization in the investment grade corporate bond market would certainly help. To see the stock market hold support, so that's what I'm here to do. Show you the same support levels. Here's our zoom in, take away all the lines here. Show you, the official QQQ short trade. We're still profitable. We've been profitable, I think, since we entered this thing, or most of the time. And there's that big support level we hit the other day. So we had that very impulsive bounce yesterday, but I cautioned you not to read too much into it. We haven't seen a gain like that in years, but it's, again, just par for the course. It's normal during these periods of extended volatility. You're going to see these big back and forth swings. So as of today, from the daily charts, I was about to say nothing technically significant has happened yet, but we are back. Yes, a little. I could say that something technically significant has happened, and that is a rejection off the 200-day. Remember, we rallied up to and took it out by a little bit, but as I've talked about, in a volatile market with huge price swings, support and resistance levels are going to be overshot on what I call momentum fueled overshoots. So you got to give it a little room. If that's 200 days there, and that's why the stop on this trade was set comfortably above there, to allow for exactly that, to allow for them to slice through it. And I go back at different points in time, I've noticed that's what is the norm, to shoot through the 200s and then only to regain it a day or two later, whether it's to the downside or upside. So basically we do have a rejection, a test, a back test and a rejection off the 200, and we're back below the 200 SMA, simple moving average, right now. But the big level still remains Friday's lows right there. Monday's lows need to be taken out. And then when we go down to the 60-minute chart, I gave you trend lines. Somebody asked, and I did post on the homepage, these uptrend lines off the lows recently. I initially gave you the ones on the futures. Here they are right now on QQQ. So that's a level to watch. If that's broken, that should trigger, and you want to see it broken on a 60-minute closing basis. You can sometimes have a little whipsaw move through there only to see the 60-minute candlestick close back above there. But you either want to see a solid close or a big red impulsive move. I mean, if you're 35 minutes into the 60-minute candle before it prints and finalizes at the end of the hour, and you're down here, you're probably not going to snap back and recover it. And then, of course, as I said, the lows from Monday, once that goes, that has the potential to open the next door of selling. Could be pretty impulsive. Maybe this wedge continues to build. We could extend these divergences to at least some point, but if and when they are taken out, what I mean by taken out, negated, when we cut down below these previous reaction lows, if the PPO does this and this, and takes out these lows, it's negated. And as I said, fewer things in trading and investing are more bearish than a failed either bullish breakout or a bullish setup. Because like I said, my normal instinct or MO would have been to go long, close all shorts and go long for a much larger swing trade when that divergence started setting up there and the market fell to support on Monday. However, kind of overriding the technicals in lieu of the to what I believe are overwhelmingly negative fundamental developments in the economy due to coronavirus. Alright guys, another long video, and I know this one was mostly just kind of talking fundamental ramblings, things that I worry about, and like I said, that I hope I'm wrong about. One thing is recessions and corrections of bear markets are inevitable. They're just part of the natural business cycle. So, whether we get one now or somehow this market pulls a rabbit out of its hat is yet to be seen. But I did kind of want to lay out the bigger picture, and that can help you decide then what are you going to do, with your long-term funds, 401k, how are you going to trade this market, and again, kind of how my mindset goes into where I'm usually pretty, I usually put the higher weighting on the technicals, but in some cases, like recently, I'm kind of I'm dismissing some potential developments that I see, bullish developments, and kind of trying to stick with the trend here and go for a larger gain on that QQQ short trade and the corporate bonds, letting those run for now unless I see some kind of stabilization, some bullish developments in the market. Palladium, I mean, massive bubble. Not so much a bubble. There has been, a shortage of palladium, but as I've said, I've been eyeing this one for a long time for the next bear market, and this will be tremendously profitable to trade. I think it's already a short. I think the top is most likely in on palladium, and probably the stock market as well, because palladium has been a growth on economic. Has been a trade on economic growth. The primary use is, in emissions mission controls for vehicles, and so is Ford going to be selling more cars? With the everything that's going on in the economy? No. If the economy takes a turn, everything comes to not a halt, but you're going to see demand in auto sales drop off, and therefore the demand for palladium is going to drop off, and palladium set up for potentially crash level type move down. I won't even play around. The downside, I think, over the next business cycle, if the next business cycle, when it comes, the next recession from here is about 65% off the highs, I think, at least. I've talked about it. I've done extensive videos where I've showed you the prior cycles, and this palladium is subject to huge gains during bull runs and huge drops during bear runs. So don't think that a 65% drop is crazy. At minimum, here's a level here we'll come down to, and that's about 44 or so percent below the recent top. Still plenty of room left downside. There's a little trend line here it's at. I'm on palladium futures too, if I didn't mention that. There's an uptrend line that may act as support, but with such negative, clean negative divergences at the top, it could just smash on through those support levels. So I probably should get back to the PAA chart, PALL. I've shared it before. I need to update it and clean it up and put some targets in for you guys. Maybe make this one an official trade. This is PALL. I just want to say, if you don't trade futures, this is the only option. And before I get the questions asked of me, no, there is not an ETF or an ETN out there that shorts palladium. So the only way, you just have to have a brokerage account, a margin account, where your broker will let you short. And then, of course, at some point, there'll probably be, once everybody realizes the gig is up, there'll probably be a high short interest for a while on this, and therefore some or even all brokers may not have shares available for you to short anymore. Interactive Brokers typically has the best availability of hard to borrow shares, so you can, if you have an IB account, you can try that. And just keep in mind that anytime during a bear market, when if it's not a very liquid security like this, for example, this one, you can be short, you can be rocking and rolling on your short position. All of a sudden you get a notice from your broker that they don't have the shares any longer available to lend to you, so they're going to call in that position. What that means is you either close it out or they're going to close it out for you if they can't find the shares. So that's how that works. So whatever. I do see downside. It's just going to be a tricky one to short, like I said, because I've we've had some short trades on this in recent years, and a lot of the members of the site say that their broker didn't have any shares for them to short. So, like I said, if you can't short it, then I think there's an alternative with Palladium and Platinum together. And I need to recall that ticker symbol, and I can't recall it offhand, but I'll get back to you on this. All right, let me wrap it up here, get the video out to you guys, and NQs just took out today's lows, so that looks like we might be headed lower now. Let me finish this video, get back to the that chart there. Well, not QQQ. NQ took out today's lows. QQQ. Oh, it took out today's low, but it hasn't taken out this trend line yet. So getting close. We'll watch that. All right, I'll wrap it up here, get it out to you guys, and I'll try to get a shorter video out next time. Just kind of, show you a quick view of the charts. But like I said, this one I just wanted to kind of talk on some fundamentals and some different things that kind of are interrelated and how they could develop here going forward. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.